For decades, cannabis businesses have paid federal income tax on revenue they couldn't deduct from. No tax deductions for business expenses were allowed at all. It all traces back to one line of the 1982 tax code. Last week, the acting attorney general signed an order that takes that line off the table for part of the industry. Today on Pat Talks Law, the order that rewrites the cannabis tax code overnight, who it leaves behind, and the trap that survives all of it. On April 22nd, 2026, Acting Attorney General Todd Blanche signed an order moving two categories of marijuana into Schedule 3 of the Controlled Substances Act. FDA approved drug products containing marijuana and medicinal marijuana products sold under a qualifying state issued license. The order draws its authority from the United States obligations under the Single Convention on Narcotic Drugs. This didn't come out of nowhere. On December 18th, 2025, President Trump signed an executive order on medical marijuana and CBD research. The order directs the Attorney General to take all necessary steps to complete rescheduling under federal law, including Title 21, Section 811. Tomorrow, April 29th, the DEA opens its medical marijuana dispensary registration portal at 9 a.m. Eastern. 8 weeks after that, on June 29th, an administrative hearing begins in Arlington, Virginia. It must conclude by July 15th, the deadline written into the president's executive order. If these breakdowns are useful, hit subscribe. Pat Talks Law goes deeper every week. Schedule 1 puts a substance alongside heroin and LSD. Schedule 3 covers ketamine and Tylenol with codeine. The legal frame around medical cannabis is changing categories. To see why that matters in dollars, look at what state licensed cannabis businesses have been doing every April since 1982. A normal business deducts ordinary and necessary expenses under Internal Revenue Code Section 162. Wages, rent, supplies, utilities, equipment, the standard list every American small business uses to compute taxable income. In 1982, Congress added Section 280E. The rule is short. If your trade or business consists of trafficking in a Schedule 1 or Schedule 2 controlled substance, you cannot deduct any amount, not wages, not rent, none of it. For state licensed dispensaries, that has meant paying federal income tax on gross profit instead of net profit. Effective tax rates routinely run north of 70%. Some operators have testified to triple digit effective rates after state taxes layer on. The practical result: the federal tax code has been the single largest expense on the average cannabis P&L. Move the substance to Schedule 3, and Section 280E stops applying. Rent, payroll, utilities, depreciation, all of it back on the deductible side. For the first time since 1982, an FDA approved or state licensed medical operator computes taxable income the way a hardware store computes it. Treasury and the IRS have already announced that they plan to issue guidance specifically on this question. The guidance is expected to address two things. One, how a business with mixed activity should allocate its operating expenses. A licensed operator that sells both medical and adult use cannabis still has Section 280E applying to the adult use side, so the deductible and non deductible activities have to be apportioned. Square footage, headcount, revenue mix, these are the likely allocation drivers. Two, the effective date and whether there is any retroactive application. If the effective date reaches back into open tax years, amended returns become a live planning question. There are operators sitting on past returns where Section 280E added millions to federal tax liability. Whether any of that can be recovered is the question every cannabis CFO is asking right now. That guidance is what tax counsel will be reading the second it drops. The order is narrower than the headlines suggest. Three things it does not change. First, recreational cannabis. President Trump has publicly opposed legalizing adult use. The order covers FDA approved drug products and state licensed medical cannabis. Adult use operators are still in Schedule 1 territory and still inside Section 280E. Second, banking. The Bank Secrecy Act still requires every business receiving more than $10,000 in cash in a single transaction or aggregated to file IRS Form 8300. The minimum penalty for willfully failing to file is $25,000 per form. Structuring transactions to avoid the filing carries criminal exposure up to 5 years and $250,000 individual fines. Third, the rulemaking is not finished. The DEA hearing has not concluded. Until it does, the IRS can keep enforcing Section 280E exactly the way it has been enforcing it for 43 years. So, what does the next 90 days actually look like? April 29th, tomorrow morning at 9 Eastern, the DEA portal opens. State licensed medical operators can begin registering. Until further regulation is published, that registration appears to be the gateway into whatever federal protection ultimately attaches to a Schedule III medical cannabis program. June 29th, the administrative hearing begins in Arlington. July 15th, it must conclude. Somewhere in the window after that, Treasury and the IRS are expected to issue Section 280E guidance. Tax counsel gets interesting earlier than that. If the premise is that cannabis no longer fits the meaning of a Schedule 1 substance, an argument exists that it never should have been treated as one. Whether that argument supports amending prior returns to reduce outstanding liability or pursue refunds is going to depend on the language of the guidance and the appetite of the operator. Either way, the conversation shifts. For state licensed medical operators, computing taxable income starts to look like the way every other American business has been doing it for 43 years. Thanks for spending the time. If this breakdown was useful, hit subscribe. The like button helps more than you'd think. I'm Patrick Nolan. This is Pat Talks Law. See you on the next one.